Hey everybody, welcome back to our channel. Today I'm going to show you exactly how you can invest in the stock market in 2020 step by step. We all know this year has been crazy all across the board. Ever since COVID-19 showed up, we had to go under lockdown. And because we had to go under lockdown, many people had to stay home. All of us had to stay home. And for the fact that we had to stay home, a lot of people started trying to find different ways on how they can have, they can produce streams of income, how they can be able to make money from home. And one of the sectors that many people have been looking into this year has been the stock market. We've seen an unprecedented amount of people that have expressed interest in the stock market, but there are so many people, as we use the term newbies, they don't exactly know how the whole market works, and there are so many people that are still having or expressing interest into the stock market, but they don't know how to start. They don't know what is the stock market. They don't even know what to stock or even how it works. A lot of people think it's gambling. Let me assure you, it's not a gamble. It's not the lottery. It's definitely not something where people think it's a game of guessing. It is not. You can literally make a living off of investing into the stock market. But before I move on, please support our channel by smashing the like button and subscribing below and turning the notification bell. So here we go. Without further ado, what is the stock market? Before I tell you what is the stock market, I think I need to explain to you what is a stock. But before I get there too, I need to go to the term, the basic. Just like I said, I'm going to explain to you step by step, simple as possible, so we can all have a better understanding of what is the stock market and how to invest in the stock market. So let's take a company like Apple. They make different products like iPhones, MacBooks, etc. You all know, I know, it's very much well established. Let's say I want to be able to own a portion of the company, and that portion is going to belong to me for as long as the company is still in business. So if Apple is still going to be in business within 100 years from now, I'm going to own those, whatever portion, whatever amount of that I'm going to get in the company, and it is going to be mine and mine alone. And the more the time goes by, the more the value of that portion that I own in the company grows. So let's think about it this way, as a huge pepperoni pizza, right? And each slice of that pepperoni pizza are portions of the company you can own. And if I'm buying one slice, or if I'm getting one slice of that pizza, it means I have a portion. It's like a share of that company. I am sharing a portion of the company. If it's Apple, that means I am sharing one share of the company, hence the name shares. The more shares you own in the company, the more you start building up a stock. It's like exactly like the pandemic. A lot of people started buying toilet paper because they started stocking toilet paper. So the more toilet paper you got, the more you started building up a stock. I have a stock of toilet paper, hence the name stocks. The more shares you own in a company, the more you build up your stocks portfolio. And now, what is the stock market? Now it brings me back. The stock market, think about it like a huge warehouse where many people come from all across the board with what they own, and they want to exchange from one person to another. So let's say I have 2 slices of pizza that I bought for $5, and then I am going to this warehouse where I know somebody else is going to buy it from me for at least $7 or $8 per slice. So if I purchase 2 of them for $5 each, I spend $10. And when I'm going to the warehouse and I'm selling it for somebody else who's going to purchase it from me at $8 per slice, which means those 2 slices that I had I'm going to be able to sell them for $16, which means I just made a $6 profit off of those 2 slices. So there are 2 ways that you can invest in the stock market. There is the long-term investment, which are usually referred to as investors, and then the short-term investment, which are usually referred to as traders. What is a long-term investment? A long-term investment, which, like I said, referred to as investors, are usually the people that would buy or purchase shares or stocks in a company or different companies, and they will hold it for a certain period of time. Usually it's a longer period of time, that at least a year or more, because they believe this company is going to have value. This company has a future. This company is going to bring more and more profit. So they're going to try and buy for the lowest prices possible as they can, and then hold over a long period of time and build up a much higher and higher and higher portfolio, basically more and more value. And then they can start selling whenever they feel like they have made more than enough profit. Those are long-term investment. So here's a way that I can show you. I'm going to go step by step by showing you all the math behind it, so you and I can see exactly what I'm talking about. So here we go. I'm gonna flip it to the computer. Now, here's what exactly long-term investors do in a long-term investment. I picked Snapchat, which is the ticker symbol in the stock market to trade with is Snap, but I wrote it here in the print it says Snapchat. So I'm going to bring up this screen here a little quick. So this is Snapchat, and this is year to date. So you can see at the beginning of the year, Snapchat was trading, as you can see, around 17, 18, and then you can tell these are the dates. And then the highest point was about February 4th, which was 1898. And then COVID-19 became serious. We went all the lockdowns and everything else. There was fear. People started selling off, and then it went down all the way to 837. And then after that, we started recovering. We opened up the economy, and then all the way up to $43.17 as of technically last week. All right. So this is what long-term investors usually do. And this is how you will see how this works. So let's say when it was down to $8.37, you bought 100 shares. The reason I say 100, this is going to be a topic for another video to much better explain this, but for now I'm just going to tell you this 100 is basically the least number you could or the least amount you could possibly purchase in order for you to make something significant within the stock market. At least 100 shares. But this is a topic for another videos, and we'll go over with it. And this gives you a total of what? $137. Oh, sorry. $37. Right? Let's say you purchased on that specific date. You got here on March 17th. I mean, March, I believe March 18th, you purchased. And then if you're long-term, like I said, you're holding. And then by the time we got last week, like I said, the price was what? $43, and I believe that was 17. Now, since Snapchat is at $43.17, you gotta multiply that by 100, because you own 100 that you bought, and now you have $4,317. You see the difference? This is how much, this is over 100, over even 200% return. How do you know that? Here it is. We're going to take 4,000. I'm just going to do from here. We're just going to do minus 837. And then we're going to take the whole thing and divide it by 837. Now you have 415.7% return on your investment. So you see, The reason why I use 100 is because I understand when you're starting off, you don't have a lot of money to put in because you're still very skeptical. You still want to figure out how this works. So you want to put as little as you can, or this is what you can afford. So I'm not putting big numbers. I want to put there so you can see it's something that you can do too. So now if you do imagine, if let's say for example you had about $8,000 that you could spend, you bought 1,000 shares, that would have been $8,300 and $70. You gotta add 10 right here, and then basically your total right now would have been 43,170 because you gotta add 10 here for investing $8,000 if you did in Snapchat. So that is one way. But let's say for example you bought Snapchat, you didn't know, because a lot of people say, well, how do you know this is the dip? I'm buying the lowest possible. Let's say for example you wanted to get in and then you decided to buy but at the wrong time, because a lot of people usually say I bought in but then I realized I overpaid, it was too much. Let's say for example you bought in at $18.98 when it was at the top. All right, let's say you bought 18.98, right, times 100, that gave you $1,898, right? Let's say it drops. This is the moment that investors don't fear. A lot of people start fearing and then they start selling all over the places. Investors don't fear. You might think you lost. In the short terms, it looks like you lost money because when it dropped all the way down to $8.37. But which means your value went from $1,898 down to $837. But investors don't fear because this is an opportunity to even buy more, to average everything down, because every single time there is a dip, that's when investors find ways. If they had overpaid for something before, they want to reduce it. The only way that you lose is if you decide to sell when the price goes down, then you lose, because as long as the company is still around, you haven't lost your money yet. You still have it. It's still yours. It's still a part of the company. And guess what? The stock market only goes down temporarily. Only goes down temporarily. I'm going to repeat this. Only goes down temporarily, and it always go up. Always, always. And I'm going to prove that to you. Here it is. I'm going to go with the S&P 500, which is an index that tracks 500 of the largest companies, and its market cap is about $30.5 trillion. Here, I'm going to go up to 5 years. You can see, you can tell the stock market, even if we go back, I just went 5 years, but you can go back 10. It goes up. It goes up. And you can see every dip, it's always temporarily. There is a dip, and then we go back up, and then another dip, but we go back up. They're all temporarily, but we always go up. So as long as you own your share and as long as the company is still around, you haven't lost your money. You're always going to end up profitable. But how do you play this place? So that's why I'm going back to Snapchat. Like I was saying earlier, here today. All right. So let's say you bought right here, but then the stock dropped to here. What do? Most investors, what they will do is they will buy more. 837, they add more. I'm just using 100 again, so it's more like something everybody can afford. But the more money you have, the more you can buy. You can buy as many as you want, but this is just to make it as simple as I can. So here we go. Now you have 100 shares that you purchased for 108,098. I mean 10898, and then you have one more 100 shares that you just purchased for $838. Now you have 200 shares, and then what we gotta do is we just add up 1,898, these two together, and then we got 2,660 for 200 shares. Now, how do you know how much now you just brought your average down, because the first 100 was at 18, almost $19, and then the second 100 is below. So you get, what's the price in between? You have just brought everything down to a much, much lower price. What you gotta do is just take this and divide it by 200, and then this gives you 13.3. So now it's like you purchase 8 shares that you own for $13.3. So you're somewhere in between, but you see, you have just brought your average much, much lower. And now guess what? Now that we know the price of Snap went up to 43, I believe 17. Now you have 200 shares. Now what do you have? 8,634. If you take your initial investment, 2,660, now you have about 5,974, which after you do the math, it's 224%, roughly. So either way, you come up into the positive, no matter what. So when you find the dips, like right now, we're about to go into the election. There is so many uncertainty going on. So every single time you hear that the market is going down, there is it is crashing, or we have a temporary correction or anything like that, it's usually the time to buy more. That's what long-term investors do. I am going to tell you, I'm going to talk about short-term investment, which is referred to as traders. So there are also two kinds of traders in the short term. There are day traders, and then you have swing traders. Day traders are the people that buy and sell. Like I've been saying, I'm keeping it to the simple term as possible. Day traders are people that buy shares in a company and then sell them within the same day. They don't hold. All they do is they buy for the cheapest price they can on the same trading day, and then they try to find somebody who's going to buy it from them for a much higher price. And they repeat that over and over and over. Some day traders can make 5, 10, 20 trade in a day. All they do is buy low, sell high, buy low, sell high, buy low, sell high. And at the end of the day, when the bell closes, when the market closes at the end of the day, they don't own anything. But all they have is the profit that they have made during the market hours. Those are day traders. And then you have swing traders. Swing traders are the traders that would buy a certain stock, shares in a certain stock, or a certain company, and then they're gonna hold it overnight, or 2, 3 to 4, 5 days at the most. Not too long. They're only buying for a short period of time. They only buy something because they're expecting that within a day, 2 or 5 days, it's going to increase in value, and they're going to dump everything. So what they do is they find the lowest value as they can purchase at that price, and then go ahead and sell it, 2 or 3 days down the road. Those are swing traders. And I'm also going to show you again with the math and all the numbers behind it, and you can see what day traders do, and then you can look at yourself and see if, as a person who has interest or expressing interest to invest in the stock market, which one do you want to be? Do you want to be a long-term investor, or do you want to be a short-term trader? Or if you want to be both, because you can be both. So without further ado, I'm going to show you again. Here are the numbers. Here we go.
Short-term investors. How exactly they do? Well, short-term investors, like I said, they go over on a daily basis. They don't hold anything over uh they don't hold anything overnight. Those are day traders. So day traders, I'm gonna go on a daily chart. So one day, and you can tell from the morning, 9:30, that's when the market opened. This is New York time. Um this is Eastern Standard Time, and then it closes at 4 p.m. So this is what day traders do. When the market opened, as you can see, Snapchat went down because during the day a stock can change in value. So what they do is they try to profit off of the gaps in between, because as there's so many people buying in and then so many people selling at the same time, the the stock, the specific company stock changes and fluctuate during the day, and they profit off of those fluctuations. So they can make multiple trade during the day to reach a certain goal. Let's say some traders might be like, I want to be able to make $300 per day. Some it's $500. There are some that make $1,000 and $2,000. It just depends on how much they have and how many trades they can make, how many profitable trade they can make. So what they do is, because they don't want to hold anything overnight, because they don't want to have to deal they want to have more control over their money. So this is what they do is, when the market open, they don't buy. They wait when everything goes down. You see, it goes all the way down, and let's say they bought somewhere right here at $39. You buy 100, right? You're gonna cut 39 times 100. Again, I'm using 100 because it's something that could be affordable for at least the majority of us. That's $3,900. Then a few minutes later, it goes up to what? 39.97. What's the difference? Now you have 39.97 again times 100. Now you have $3,997. So if you take minus the initial investment, they have just made $97 in profit. Just a few minutes after, it could be 30 minutes later. But here's the thing, that's not the only thing that they make, because they make multiple trade. So this is the first trade they're gonna make, because they have a goal. Let's say their goal is $300 or $500 a day. They just made their first $97, and then they go in, they find another stock. Let's say they go on, I'm gonna pick this one, SPCE. This is Virgin Galactic. Again, on a daily basis, they do the same thing. This is the stock. They come in at $17. That was the lowest price. They buy somewhere here, 1706. Here we go, 17.06. $1,706. And then, as you can see, that was around 10:55, and somewhere around 12, it went up at 1767. Again, 17.67 times 100, 1,667. 700, sorry. Here we go. 06. You have about $61. Now you take this $61 and then you add the $97 together. And that becomes $158. All right, there we go. So you see how this works. But they're gonna make multiple trade, 10, 15, 20 trade. And then the more trade they are making, see, this is only in 2 trades. Now imagine if you make 10 trades, and this can go all the way up to $500, $600, $700. This is how it works for day traders. And then swing traders, as I say, they will buy. Let's say they buy today. This is they bought today, and then 5 days later. So you see, let's say they were hoping that the stock was going to be going up, and what they do is, okay, they buy in a certain day, at a very low price, whatever it is, and they're expecting that, let's say they buy at 17.05 right here, and they know maybe in 2 to 3 days it's going to be 19 or $20, and then they will sell it. That's a swing trade. This is kind of how the whole thing works.
One of the biggest questions that we get is where to invest in the stock market. Well, there are so many different platforms out there. You got platform like even apps on your phone that you can get, like Robinhood app. You got the Webull app, and then you have platform like TD Ameritrade, Charles Schwab, and so on. But when you start talking about TD Ameritrade and Charles Schwab and every other bigger platform, the more professional you become, the more you start using those, because they come with a lot of different things, so many different information. You need to be a little bit more advanced to understand those. And so when you're still a beginner, we usually recommend for as Webull. Webull is one of the apps that you can actually download on your phone, and you can invest with it. It's very easy to use, and it provides you with a lot more information, at least for the basics of what you need if you want to start investing. And we're going to provide a link below. If you actually go in today and sign up with that link, I believe Webull is going to be giving you 2 free stocks that are going to be valued between $8 and $1,600 using the link below. But there's also Robinhood. I have personally used Robinhood before. I'm not gonna say it's exactly the best. The more advanced you become, the more you realize you need something much more advanced. But you can still use Robinhood. It is a good platform. A lot of people uses, especially when they're beginning, they want to use Robinhood because Robinhood is very easy. It is the simplest platform you could possibly find out there when you start. And everything is pretty much self-explanatory. And to sign up, it only takes, I believe, it's like less than an hour. I believe you can do everything in 30 minutes. You're done, and you can either deposit money and start trading. When the market is open, of course, you can basically do that. So I really appreciate you guys watching this video. And again, don't forget to smash that like button below, subscribe to our channel, turn on the notification bell so you get notified every single time that we post a new video. Thank you so much, and well, share this, and I'll see you in the next video.